After a period of prolonged uncertainty, marked by the government and the RBI's skepticism towards virtual digital assets, a new tax regime for cryptocurrencies was finally unfurled in this year's budget, and it came into force with the onset of this financial year last week. The introduction of a separate taxation system was seen as a relief by the industry as it gave an air of legitimacy to cryptocurrencies, but it looks like it wasn't much of a relief. The new norms affected a flat 30% tax on profits made from the transfer of crypto assets and NFTs, irrespective of the holding period. The gains from virtual digital assets are being taxed in the same way as those made from gambling, lottery, or horse racing. No deduction except the cost of acquisition is allowed. Crypto gifts are also taxable at the slab rate if their value exceeds 50,000 rupees. And if that was not enough, a far harsher tax deducted at source at the rate of 1% for every trade will be levied from July 1st if the aggregate transaction value in the financial year crosses 50,000 rupees. The buyer must withhold the TDS on behalf of the seller. Experts warn that the TDS will suck out liquidity from the market by forcing high-frequency traders to curtail their trading. Some even warn that the government's decision not to permit offsetting of trading losses in digital assets may lead to an exodus of crypto companies from India. Meanwhile, Indian crypto exchanges have been witnessing higher volumes in the past week for multiple reasons. New investors are entering the crypto market as they view the tax as a tacit recognition of the asset class by the government. Some traders have booked profits to take advantage of the prevailing system, which, unlike the new framework, allowed set-off and carry forward of capital losses in crypto. While some investors are squaring off their positions to start the new year with a clean slate.
We kind of have seen some drop in users, especially during the 31st March. The selling has been more. A lot of traders have been trying to square off their positions. So yes, slight impact is there, and we expect that it should pick up again in the coming few days. The industry continues to attract more users. From the day the taxations were announced in the budget session, since then it has been a phenomenal increase. The TDS slab is pretty high. This would definitely discourage, day traders, people who are looking for arbitrage opportunities. It will impact the market making or the liquidity providers. This will kill the innovation, basically. A lot of things that have been mentioned in the bill. The definition of certain terms need to be clarified. We as an industry, we are working towards creating some very simplified products which can be integrated into the platform itself, so that people, when they are buying and selling the assets, they are able to track their P&Ls, deposit their TDS via the integrated systems. So we are trying to make this system as seamless as possible for the users.
In a way, the tax puts an end to the constant uncertainty that plagued the sector in India for half a decade now. The industry welcomed the move even as they bemoaned the prohibitive taxes which threatens to accelerate the brain drain and discourage innovation. Experts have highlighted the impracticality of enforcing the TDS provision, especially on foreign exchanges and in the case of crypto-to-crypto trades, where there is no clarity on who will be designated as the buyer. Given the nature of the industry, which lives by the ethos of decentralization, enforcing TDS becomes arduous. As TDS will dry up liquidity on exchanges, investors will neither get the best prices nor quick execution of trades. This may also push traders to the grey market and devise ways to evade taxes. Individuals with resources, high-frequency traders, as well as startups and entrepreneurs in the cryptocurrency and Web 3.0 ecosystem are now being incentivized to shift their base to crypto-friendly jurisdictions like Singapore and Dubai in the UAE. India may see a brain drain of thousands of highly skilled developers.
Being the first of the financial year and crypto being in the news, our signups and volumes are definitely much higher. Some people are panicking. There are a lot of questions about TDS from the customers. There is still a lot of clarity that's awaited. For example, see what happens to the international exchanges that don't adhere to this, or what happens to the DEX. There are decentralized exchanges. TDS is the money that you are going to get back. Though 1% TDS is very high, in any markets, market making liquidity provision is a very significant thing. Problem here is that there is a significant part of the capital getting locked, and there are some questions that, like I said, we don't have answers, right? If they trade in a DEX, right? Who is responsible? How do they ensure that the other person deposits this particular TDS? And even in a DEX, you don't even know who is the counterparty. I hope government will see the rationality and they will reduce the TDS to something like 0.1% or 0.2% for a trader perspective. From an investor's perspective, TDS is not a deterrent at all. And then the second part is 30% tax. Some people are worried about that. The people who are really worried are also those people who trade heavily in crypto. I'm not seeing this that they will leave crypto because of this tax, because when we talk about crypto, the amount of returns that you are getting is pretty high. If government could see physically that a lot of brain drain is happening, people are setting up their offices or trades out of Dubai or Singapore, and we are losing out on tax revenue, some kind of rationality will prevail eventually. Of course, not 100% of the international exchanges will comply. Will government ban all these international exchanges? How will government find each and every international exchange and ban it? Right? It's very difficult to implement. A lot of people start trading in cash.
The tax has come as a body blow to an industry that was starting to thrive. Venture capital funding into Indian cryptocurrency and Web 3.0 startups grew 28 times to more than $500 million in 2021, according to a Bain & Co. report. Indian crypto exchanges CoinSwitch Kuber and CoinDCX turned unicorns in quick succession last year. Polygon, a decentralized scaling platform for Ethereum blockchain, raised $450 million through a private sale of its native token Matic to venture capital firms in February. Polygon was founded in Bengaluru by 3 Indians as Matic Network in 2017. However, in order to de-risk its business from geography-specific regulatory concerns, Polygon has distributed its operations between several countries, keeping only a limited presence in India. Geotis co-founder Arjun Vijay says India will be forced to play catch-up a few years down the line if it lets go of an opportunity that's presenting itself now. With 3 months to go for the TDS provision to kick in, the industry is hoping the government will heed its warnings.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.